Typhon's been around since 2008. I come from a kind of diverse background of being a trader, a software developer, and a securities lawyer. So when I conceived of the firm, the idea was to combine all three of those disciplines and create what George has since dubbed a deconstructed multi-strat hedge fund. And what is that exactly? Well, I try to think of it as the best of all worlds between a pass-through platform like the big multi-strategy firms where our portfolio managers are in-house. We have order book level access to all of them so that we could risk manage them properly, keep proper risk constraints, and knowing what's going on with all of our PMs every second of every day. The best of a fund of funds, and that we can build custom portfolios. And we actually have a lot of fund of funds clients because since our managers are in-house, we don't charge any layered fees. We're just partners with our managers and work on a revenue share basis. So all of the internal controls, the risk management, the business functions that we provide for our managers comes as no added cost to our managers. And also, like a managed account platform, we are structurally agnostic. So right now we're in the process of launching a fund of one for two different fund of funds. We're launching a swap on a major investment bank platform that is a custom portfolio of 8 different future specialists for a $30 billion institutional investor. And we're about to launch probably in the fall 2 private funds that are multi-strategy in nature that combine all of our PMs, both in fund structures for strategies like Vulcan that trade physicals and things that you can't really do in managed accounts, as well as our SMA managers. So we could trade some of the more operationally intensive strategies in that multi-strat, as well as get some benefits of notionally funding the futures SMAs. And we weight those products using a risk weighting algorithm. So that starts with a volatility weighting structure, and we algorithmically decide allocations on a more forward-looking basis. So we could look at not just past realized risk, but expected future risk based on a number of risk factors.
You know, just a quick sort of intro to how I think about risk and what I like is sort of the ethos at Typhon, which is it's less about being right and much more about risk management discipline. We're not especially talented fortune tellers. We don't want to be. What we want to look for, and what I specifically look for in my funds, but is generally true in my experience here at Typhon across our outperformance with every portfolio manager, I think in times of crisis proves that. We're looking for asymmetric returns. We're looking for long vol biases. We're looking to catch the market offsides in terms of being overly weighted or overly confident in one direction or the other, and using things like vol, or in this case, Fed fund futures, to express asymmetric bets when we can, at potential pivot points in the market and inflection points in risk. And so luckily we've done that quite well this year. I think if you look at longer term data from Typhon predating me, you'll see that there's a trend in negative correlation alpha, which is, in my opinion, a clear, obvious portfolio construction building block for whatever your really long-term or short-term objectives are, reducing volatility, increasing, obviously, returns. So it's been a pleasure to work with like-minded people in that space going forward, looking really not to stake sort of a prediction in the sand along those lines, and really look to just preserve wealth in these very hard to predict times, harder than even usual. And wait, I think we're approaching another moment here where the market may have gotten ahead of itself and be able to capitalize on it without having bled away all the profits in the interim, so that we have the bandwidth to be able to capitalize and make money in this opportunity as well.
It's pretty gratifying when you get through a crisis environment like what we've seen in Q1 and be like, the philosophy worked, the model worked.
The success of this really comes from the risk that we wrap around everything, this collaborative, proactive process where as a group, we start to understand what you're doing as a trader and how it all plays together. And then when James has the overlay with it, you really start to see how this pushes forward and how the results come about. It's exciting.
During this time's volatility, it's really important to have a team surrounding us. So we have my team here in New York, but we, as what everyone saw with this high volatility and whatnot, we've actually reached out to Dave Klusendorf and James Catullus, trade structures and a few different things during this period where we wanted to properly balance and properly be able to represent our positions in things sometime outside the box, where sometime an outside eyes can really help with these situations. And being a fully discretionary fund, we like to rely on our team for those things, as well as constant risk management.
The risk management we have with the Typhon team and being able to discuss strategies or ideas with Clue and James, and not only those guys, but our other PMs as well, is a huge help.
So this is what the swap performance, look like. So, this product was designed to have between 72 to 77% nominal allocation to commodities at all time, and to average only 3.8% margin equity, and investors could lever from there as much as they see fit. So these are the unlevered returns. So you see, really our design thesis, from day one is that it's not our job to give you beta. Okay, if you want equity beta, you could go buy an S&P 500 index fund for almost free and let it sit there, right? I don't think we have an edge in beta. We don't try to outperform the S&P markets. What we try to do is have every manager in Typhon have single-digit correlation to equities, bonds, fixed income, real estate, other hedge funds, and each other. Okay, and we don't care only about just the mathematical correlation. We also care about having independent return drivers. Why is that? Well, in stress periods, the old adage is all correlations run to one, because everybody sells everything at the same time. So how do we avoid that? Well, we look at strategies like relative value or short-term microstructure-based trades, event-driven trades, market structure trades. Like in the VIX, we run a roll-up, roll-down the curve strategy where we could be short vol, we could be long vol, we could be flat. It all depends on what kind of term structure regime the VIX is in. And Jared, he's been with the firm 10 years. He's a farmer. He grew up in Indiana on a farm, helped his dad sell the grain back when he was in middle school. He consults to grain elevators, to ethanol producers, is a weather expert, gets up in planes and does low-flying crop surveys. What weather is affecting supply and demand variables in the grains? Nothing to do with what's going on in the stock market or in the bond market. Alex Green is an event-driven options manager, has several different rule-based strategies that go along these micro events within companies, also trades the VIX term structure. In these types of strategies, they tend to not do the best in market environments like 2019, when you just have a melt-up, ultra-low, volatility, market regime. But, as a firm, we started trading in Q4 2008. We put up 35% in Q4 with our first and only at that time, manager. When many major hedge funds almost went out of business, when people were down 50, 60, percent. We had great years in 2011, 2012, which were tough for a lot of the space. Firm as a whole, almost every strategy we had made money in 2018, where 93% of funds lost money. And, you could see on the graph, basically impossible for us to have any blend of Typhon managers where we didn't have an incredible, Q1 this year. And, to our credit, George Michalopoulos, who many of you saw earlier on the crypto panel, he also trades our macro fund. He was really the first person within the firm at the end of January to say, listen, Corona is a real threat. This thing is airborne. It's got a symptomless, contagious 14-day incubation period. As soon as the thing got out of China and we started seeing it in Italy, it was inevitable it was going to come to the US and have major ramifications here. So, as a firm, we already had all our work from home capabilities in place. I mean, we've been fully, cloud-based since our inception in 2008. So we closed all of our offices February 26th. So there was no, hiccups or operational, challenges to deal with when the markets, we were ready. We capitalized, and all of our managers outperformed the S&P. All 15 of our products outperformed the S&P, year to date through March. And we made money in April too. So I saw only 13% of funds made money in both, March and April. And, we're in there. So, what do we not do? We don't chase the market. We don't try to pick tops and bottoms in equity markets. But what we do is, I beat this phrase to death, is we stick to our knitting. We have specialists who do what they're specialized in, and they do a really good job of that.